Everyone. Welcome everyone. This is the class two of the sixth series of classes for Money IQ, and I'm thanking those that are in on time. I appreciate you coming in. I'm recording the class. We'll share that recording afterwards, sometime during the week. But just to kind of go over what the objectives are for today. Today, I will be covering a number of important subjects, a number of critical information that I think we all, need to be pretty aware of. So quickly, the agenda for today will be what I have listed on the screen. We'll quickly go over the assignment we have from the first class. Again, I won't go into the full details of it, but we'll briefly go over it as the Lord will help us. Then we'll move on into I call it levers of financial freedom. We'll move into that and talk through some things that makes the difference, some elements of money management that we need all to be aware of. We'll talk through that. Then we'll look at the role of insurance in financial planning, personal financial planning. Then we'll go into the steps 3 and 4. We'll cover steps 1 and 2 of a financial planning process. Today we'll focus on 3 and 4. And then we'll go over budgeting, and then we'll finish with investment vehicles. I'm not sure how far we'll be able to go on investment vehicles today. It's a very deep subject by itself. Depending on the level of questions and, that we get in the class, we may not be able to finish it, but if we don't, we'll continue from there next time. So that's the agenda for today. Now, I won't spend time on this. I gave this assignment at the end of the last class, and I always ask people that you always take time to do the assignments. But before talking about the assignment, for class 1, we went through a number of very important basic steps or basic information that everyone needs to have if you want to truly understand how to manage your finances. We covered some financial terms. I always tell people, if you want to be financially, free, you need to understand certain financial terms. Somebody was talking to me recently, and I said, look, they're going to, this industry wants to cheat people. I think it's an artifact of the wider society. So they will use languages that you don't understand, and if you don't, they can take advantage of you. So we defined a couple of things. We talked about assets. We'll be using those terms again today. We talked about liabilities, just to ground everyone. And we said the difference between the two is your net worth. We talked about burn rate, which is your monthly expense, minimum monthly expense, money that you need to survive monthly. We talked about run rate, which is time. It will take you to get to zero cash. We talked about how to calculate it, and I asked us, we'll look at that in the assignment in a minute, to take time to do the same, calculate the same numbers for ourselves. And the other part of what we covered last week was we started looking at the compound interest worksheet. I shared a copy of the worksheet on our WhatsApp channel. Please, if you've not looked at it or done that second assignment, it's very, very important. We talked about the criticality of understanding how that spreadsheet works. We're going to build on that a little bit today, and we should use it. So we then gave an assignment. So the assignment was to build off of what we did in that first session. I hope everybody in this class has done that assignment. One of the things that I always like to stress is the importance of doing those assignments. If I speak till tomorrow, until you spend some time to do it, you won't internalize it as much as you ought to, and it will hurt you financially. So do those calculations. Again, I don't have the time to go over it unless anyone in the class. Please, if you have any question, as usual, please feel free to raise up your hands and signify that you have a question, and I'll slow down and stop and take the question. So I won't go over it in detail, but if anyone has any question after you spend some time on it, something not clear, please feel free to bring it up. This second question on this sheet was very, very important. If I'm age 25 and I just finished college, and I desire to have $1 million in investment value rather, when I turn 50. How much will I need to invest monthly to achieve this goal if my cumulative rate of return is 12%? With that spreadsheet, the formula is running in the background. You can calculate things like that, and you are able to figure out what do you need to save. Now, that number is very, very important because it feeds into what we'll be talking about today, which is budgeting. If you know how much you need to save on a monthly basis, then it's easier to walk towards it. If you're not sure what you need to save, you can't walk towards it. If you don't have a goal, that's why the Bible actually teaches us to have a vision. The Bible says that the vision is for an appointed time. If it tarries, wait for it. But without a vision, there's nothing. You're not shooting towards anything. The Bible says that they might write the vision down, that they may run. To run there means you make efforts. You strive towards that goal. You write the vision down. That's what number 2 is trying to do. So the vision here is your financial vision. Let's say your vision is I want to have a net worth of 2 million when I turn 50. Okay, where am I now? This is your net worth. My goal is now 2 million. What do I need to put aside if my rate of return is 12%, 10% on an annual basis to get there on a monthly basis? That's all that is. That's question number 2. I hope we all did it. And then the last question is, if I invest $200 a month, but I do this consistently, at what age will I achieve the 1 million goal? Still referring to this 20, 25-year-old young person. That's all I can afford, and I continue to do that. Maybe with age and increased income, that individual can do more, but that's a starting point that you could use to say, okay, even if I don't invest more, how long will it take me to get to that point? And then the third assignment really delved a little bit more into now using that worksheet as a preparation for this class. That is, what is your goal? That you should have it written, which is what I just said. And then using that worksheet, what's the monthly savings that will get you to that goal? So I'm going to actually open that worksheet, quickly, and show you what I'm referring to there, because it's going to feed into when we start talking about budgeting in a minute. So I will stop sharing this particular screen, share a different screen, and talk about what I'm referring to there. So present something else, window. Okay, so I'm presenting a different sheet now. I think I have 1 or 2 people that are in today's class that were not in the last class that we had. So just for your benefit, this is what I was referring to in what I was saying just now. When you take that future value worksheet that I had sent out, there are 2 tabs there. One is the future value of a one-time investment. Just leave it for a while. Very simple future value calculation, which I explained during that last class. But this is the future value of continuous investment. So on a monthly basis, which is really what you want to be doing, keep putting money aside. And we said, let's say you say I'm that 25-year-old, and by the time I'm 50, that is 25 years from that point in time. If my rate of return is 12%, that means that individual is looking at the column I have newly kind of placed this box around. So I'm going to take out all the other boxes for a little bit so that we pay our attention to that box. This exercise is very important regarding to planning, financially speaking. So I'm talking about this box. We talked about 12% rate of return. We talked about 25. So that is this intersection here in the box is what we're looking at. Let me remove the fill over here and just highlight that box of reference in yellow. So the intersection of column K and row 16 is over here. And we talked through all of this the last time, but just briefly, you can say, okay, this particular person will be at 1.376 million in investment value, net worth value, to make it simple. But let me use a not lower number to use that 1 million. Let me see where 500 will put us. Okay, 500 is still a little low. Okay, 600, about 610 a month is what will take you to that $1 million value. 600, let me use 650, and that will definitely take you there. So $650 monthly savings. The formula is the worksheet is taking the calculation of future value of continuous investment, which you see at the top here. And it's saying, okay, if I can set aside the only number you need to change on this sheet, let me admit the person that's waiting in the, and okay, I just admitted him. You know, the only number you need to change is this. The others, you're just reading and trying to make a sense of it. So this individual now knows that I want to get to this point, this $1 million. I will bold that, and I will unbold every other bolded number just for a little bit. Just so we kind of focus our attention on a couple of numbers. This number is the focused number. I'll put it in blue. I'll use a slightly different shade of blue to make it stand out. So this 1 million in 25 years at 12% requires $650. That is $7,800 annual investment. Now, can that person set that aside regularly? Or that's a different question. The point is that is where you want to, the kind of money you want to be setting aside on a monthly basis. I explained to Ross last time that before you start investing, I want to see who on this, you know, who still remembers sorry, there's somebody waiting in the admit, sorry. How many months did I say you need to have set aside in savings before you start investing? And why did I say that is important? Who can remember what the numbers are? How many months should you set aside in savings? And why is that important? Please, if you remember that, please just go ahead, open your mic and answer the question for us. If not, I can answer it. Anyone? Okay, I'll answer it so that we keep moving.
Sorry, do you mean, what is the amount of savings that we need to have in emergency fund before we start investing?
Yes, sir. Yes, sir. Okay.
So I think it's 6 to 8 months.
Thank you, sir. Thank you, sir. I appreciate you saying that. 6 to 8 months. The reason I explained the last time is you want the power of compounding to work for you, and life happens sometimes. Maybe someone starts on this journey of 650 a month, and it doesn't have this 6 to 8 months range of your burn rate. Let's say that person's burn rate is $3,000 a month. So your 6 months will be 3 times 6, which is 18. Your 8 months will be 3 times 8, which is 24. So somewhere between 18 and 24 is what I recommend that you have an emergency fund saved in a savings account that you don't touch. In a money market, don't leave money to be in the money market. So it's at least catching up with the rate of inflation or close to it if it's in the money market. So it's not depreciating largely in value. Okay, once you have that 18 to 24,000, then start investing, because let's say that individual loses his job and he doesn't have any savings, he will be forced, or she will be forced, to dip into the investment, sell an investment. And as I explained, the moment you sell an investment, it loses the power of compounding. And the secret of growth in investing is time. I said that quite a bit the last time. It's time. It's amazing how powerful compound interest works if we allow time to work. If we don't, then it will not work. So anyway, for this individual, we see 650 to achieve the goal. So we'll come back to this sheet later, and then I will reshare the PowerPoint, and we'll come back to this sheet later. Window. Let's see. Just give me a second to pull up the slide deck that we're working with. All right, so we're back to our slide deck. Any question about what I just explained? briefly. I know that I went over it quickly. So please feel free, like I said, to lift up your hands if you have any question, and I'll go over it. So step 3 and 4 of the financial planning process is now where you start planning your course of action. Now that I know that my goal is 1 million in 25 years, and I do know also from this worksheet that I need $650 a month, how can I set that money apart? That is where your next step is. How much will I need to save? You've calculated. How much will I need to invest each year to achieve? You've calculated. Now, bearing that goal in mind, what are the things that I can afford? What are the things I cannot afford? Which is where budgeting comes in. A lot of the time, people are scared about budget. We'll try and demystify it as much as we can today. That's where budgeting comes in. What it does for you is it gives you a tool to achieve your goal. How much you set apart? How much can you truly afford? I tell people, a lot of people can't afford the car that they are driving, and they don't even know that they can't afford it. The only reason you will think or know you can afford something is because you're working towards a goal. If not, you're going to take on a note, you're going to buy things that you don't need, at least in the short term. And then after you've kind of, and we'll practicalize that when we go into budgeting in a minute, how much can you set aside for your various expenses that are not like required? That's like more of a discretionary expense. I was telling someone recently, and the individual said, no, budgeting cannot. I said, it better work. It will work. And it doesn't matter how much you learn, you can plan and you can budget with it. How much should you give? How much should your offering be? As believers, we know that 10% of our income is for the work of God. Apart from that, every other thing is a discretionary spend. Apart from your major, expenses, your accommodation and transportation and food. Everything else is discretionary. So number 4, and we'll talk through that in a minute. Number 4 now is, what are the alternatives? Is it that I'm going to invest this money, in the stock market, or should I invest money in real estate? Should I start a part-time business? It doesn't matter what you do. The point is you have a goal and you want to work towards that goal. So you need to identify your alternatives. We'll focus quite a bit in today's session on investing in the market, in the investment market. There are other opportunities, though. That's not the only way to invest. All right. So that, in essence, leads us to the key focus for this afternoon, apart from various investment vehicles. Because once you now know, okay, this is my goal, this is my monthly savings, the question is, how do I get to it, which is where budgeting comes in. Now that I know I can now have that money set aside, what should I put it into will be the next question, which is where investment vehicles comes in. So let's go over budgeting and reconciliation. As usual, please feel free to slow me down. This subject scares many people for some reason, budgeting. And I know that sometimes it's because we feel that at the level of income that someone feels at the level of income he or she is, or the family is, there's no way they can set money apart to budget, to save. So they're scared about budgeting because it's going to reveal what they can and cannot do. And most people don't want to see that. So your budget is in the corporate world, there's a term called income statement. And I showed you an income statement last week. Really, a budget is nothing but an income statement. What an income statement is it shows all your sources of income and your various expenses on a particular period up till your income, your net income out of it. That's what an income statement is. And then a balance sheet, I used this model on the right that I got out of Kiyosaki's book, Rich Dad, to explain some things, and I will actually use it a little bit today again. That your goal, remember, I think we all remember this, that I said this is the cash flow pattern of the rich. I showed us a couple of cash flow patterns the last time, that most people are in the middle class. The middle class uses their money to buy liabilities, whereas those that become financially free, rich if you want to call it that, or wealthy, Wealth is a measure of how long you can survive if you know, even if you don't have any source of income, means of income, I should say. How long you can survive. The longer that time, if it is 50 years, that is your level of wealth at your born rate. All right. So your goal is to turn your asset into income in your income sheet. Again, that's not the subject for right now. I'll come back to that in a minute. But just going back to budgeting quickly, your budget is a statement that helps you to plan. It's a sheet, it's a paper, whatever it is, that helps you to plan all these various sources of income in the income statement, what your various expenses are. It shows you what your net income will be, and it shows you what are the things that takes money out of your pocket or the things that brings money in your pocket, and is it a plus or a minus. In accounting terms, that's what they call cash flow statement. It shows you your cash flow. It also is important that you reconcile. It's not enough to prepare a budget. You need to be able to say, okay, I said I will spend $50 on this item in the month. I actually spent 20, so I saved 30. On the overall, I said I will spend 3,000 for the month. I spent 3,200. Why did I spend more? You need to be able to do that. A budget should be prepared on an annual basis, month to month, and then summed up for the annual, because things change on a month-to-month basis. So we'll talk through that quickly in the next couple of minutes. So we'll go over my recommended sheet on how to prepare a budget. But before we do that, I want to talk about what I call levers of financial freedom. There are 4 of them, and 1 is income, 2 is expenses, 3 is savings, and 4 is investing. These are the levers that you have to pull. It is never about how much you earn. I tell people all the time, never about how much you earn. It's about how much you keep and how hard what you keep is working for you. That is the secret of financial freedom. It's never about how much you earn. How much you earn is important, but it's never about that. If it's about how much you earn, those that win lottery will never be broke. If it's about how much we earn, those that play sports and earn millions of dollars out of college will never come to a point that they go broke. So it's never about how much you earn. You need to learn to manage whatever income you have. I explained what they call Parkinson's law the last class, which states that your expense will always grow to match your income. You must break Parkinson's law if you want to be financially independent. That is, if your income is growing, don't allow your expense to grow at the same rate as your income is growing. That's Parkinson's law that you're breaking if you're able to achieve that. So anyway, the first lever is income. And there are 3 types of income. One is earned income, you have passive income, and then you have portfolio income. Every one of us in this class should begin to work towards having income in these various elements of income, within these various elements. Hand income, passive income, and portfolio income. Hand income requires that you be there, you labor, you use your energy, you do one thing. If you're an accountant, you're accounting. If you're an engineer, you're engineering. You're doing something. If you're a doctor, you are in the practice. You're doing something to earn that income. That is, if you do not do that thing, then that income will not come. That's a hand income. Then there is passive income. This is income that, whether you are there or not, will come into you. That is, whether you are leveraging either a system, you are leveraging, an investment, or maybe you have some royalties or whatever it is. Any income that can be coming in, that's why the name is called passive. It's not active. It doesn't require your active participation, whereas hand income requires your active participation. You need to have passive income. Even if you have a hand income, you need to find a way to have passive income coming in. And thirdly, we have income from portfolio assets, things like stocks, bonds, funds, all those different things produces income in their own various ways and formats. You need to have income in all of those various elements. And then we have your expenses. What you need to do with your expense is to manage it. Make sure that it doesn't grow at the same pace as your income is growing. It's a simple almost like what they call a material balance equation. Make sure it doesn't grow at the rate of your income growth. That's your goal with your expenses. Keep your expenses controlled regardless of your level of income, and don't allow it to, grow at the rate of income. So income, three types of income. Note these things that I'm saying: earned income, passive income, and portfolio income. You should have income in all of these sources. And then expenses, you want to manage and control your expenses. And then we have savings. We need to make sure that we are putting some money aside. And this is going to be leading us into budgeting in a minute. We need to figure out how to set, no matter, even if it's $50 a month, there is a way. I tell people, a lot of people after church on Sunday, they feel like they have to go to the restaurant every week. $50 can make a difference between you achieving your goal or not achieving your goal. Most restaurants today, if a family of four goes to a restaurant, I don't think there's any restaurant you will spend less than $100, for a family of four, thereabout. $400 every week, that's already $400. You can see what $650 could do. Imagine if you added that $400 to it. Now, I'm not saying you shouldn't take your family out. No, that's not the point. But let's do these things with some wisdom, knowing where we're going. It's the controlling of our expense that allows us to be able to achieve savings. It's really the point I'm trying to make there. Your goal, and as we've explained earlier on, is 6 to 8 months of your burn rate in a savings account. In a savings money market type account. That's why I keep it in a money market account before you start investing. And investing is truly what makes you financially rich, because that is what has the ability to truly compound. Savings enables investing. You can't start investing when you have no money, as it were. Now, there are some things that people do. I'm not going to be able to go into that. There's a lot of, the more sophisticated you become, the more you can do certain things. But let's just stay in the basics right now. Okay, so just as it's shown in this pattern here, your goal is to grow your income on these various three elements, either earned, passive, or portfolio. Your goal is to lower your expenses. Your goal is to grow your assets, turn your income into assets, and then asset into income on a continuous basis, like a cycle. And then, of course, you want to lower your liabilities. And then we need to, and I talked about this a little bit, I believe, the last time. We need to understand what's a liability. I like the way now accountants will define assets and liabilities slightly differently than Robert Kiyosaki defined it in his book, Rich Dad Poor Dad. But I like Robert Kiyosaki's definition that your asset is anything that puts money in your pocket. And anything that takes money out of your pocket is a liability. Most people consider their home an asset. Now, from a financial point of view, you are right. But that home is costing you money to maintain. You're paying rent, principal, you're paying interest, you're paying taxes on it, you're paying insurance, you're paying electricity. So it is taking money out of your pocket. The real mortgage or property that can put money in your pocket are investment type real estate. So we should not really consider our home as an asset, is what it was really trying to say. I know people argue against it, but for me, I like the simplicity of that definition, that anything that puts money in my pocket is an asset. Anything that takes money out of my pocket is a liability. I don't want to go into that argument, but if you keep that in your mind, it will help you to think about this much more simply. It makes it easy for you to kind of appreciate what should you call an asset and what should you call a liability. Our home is truly an asset. Let's say it grows, and then there's a difference between the amount we invested and what we've paid and the current value. Then when we make that money out of it, that is an asset. But who knows, it can go upside down as well in a different market. So that's the risk of thinking of a home as an asset. And lastly, this is not considered one of the four levers, but I want to just mention it briefly. Insurance is very, very important from a risk management point of view. As we're putting all of these things in place, we need to have insurance. There are two types of insurance. I'm not talking about, we all have car insurance, we have home insurance. That's not what I'm referring to. I'm talking about life insurance specifically now. There are two types of insurance, that life insurance now, that's important. The goal of having a life insurance is in the event that if you are the primary breadwinner in your home, something happens and you've been building some wealth over time. If you don't protect that, the downside, that money can, take can take on wings because your family, don't have any other way to take care of themselves. So we should have, insurance, life insurance specifically speaking. There are two types, the term insurance and then the permanent insurance. Permanent is usually much more expensive. I'm talking about 3, 4, 5 times more expensive than the term life insurance. But the benefits of a permanent insurance is that it doesn't expire. Term life insurance expires because, as the name goes, it is meant for a season. Let's say you are 30 years old and you take on a 20-year term life insurance. When you turn age 50, that insurance will expire. That you can't make any, they won't give you, you can't make a claim on it in case that individual passes on. So while that policy is in force or active, there's a death benefit that will be paid over that term. That's where the name comes from, term life insurance. At the time someone is making the most impact in terms of taking care of your family, that is when a term insurance is recommended, because at an age, let's say by the time you turn to mid-50s, generally speaking, or maybe late 50s, most of your children are probably on their own. They can take care of themselves. And if something happens to that individual, they really don't need you. But if something happens to that individual, maybe he took it out at the age of 30 and at the age of 45, something happens, at least the children can finish their school, without having a negative impact on the other investments and things like that. So my recommendation is for young people, before before it gets, as long as you're at a stage where you are making a lot of impact, and if anything happens to you, it will affect your dependents, you make sure you have a term insurance. Now, permanent is really very expensive. I don't think it's required. That would not, because of the level of cost involved. However, you will need to talk to an expert in that field. I just wanted to bring it up. What I recommend is a term for the period that your families are at the most risk. Okay. All right. So let's go back to the Excel spreadsheet now. I'm going to walk us through a budget statement. I see a hand up. Yeah. Okay. David, go ahead. You can open your mic and ask a question.
Sorry, sir, it's Tommy. I just wanted to understand about the life insurance. Sorry, we joined late. But does it mean that if, let's say, you put in a life insurance for that time and nothing happens, that you've essentially lost all that money?
Essentially, yes, because it is an insurance, right? And it's for a time. It's for a time. If you don't have a claim, then you don't get a benefit out of it. There are some insurances that they call it a surrender value, but those are usually a little bit more expensive. There are various nuances to that, so which might still have some surrendered value. It might not be, as much as if that something happened to that individual, but it has some surrender value. So there are some like that, but they're usually a little bit more expensive than a general simple term life insurance. I hope that makes sense.
Yes, sir. Thank you, sir.
Yeah. All right, thanks. Good question. So now let's switch on and work on the budget. Remember the Mr. A, the young man or woman that we talked about, that is 25-year-olds planning towards the age of 50 that we use the worksheet for earlier on. Actually, I think I'm going to share my entire screen this time around, and then I'll put that slide on the screen. That way, it's easier. Let's see, screen one. Okay, share screen. Okay, Bro Sam, go ahead with your question.
Okay, sir. Just a question very related to what Sister Tommy just asked. The type of insurance we have at our workplace, can we also categorize that as a term insurance? Because that is based on the job. If I'm still with the job, maybe they have like a 500K life insurance for me.
Yeah.
Does that a term insurance? The second question is that if we have that and we know that it's based on job, is it still advisable to have a separate or personal insurance outside of that?
Very good question. So that should form part of your portfolio of risk management from an insurance point of view. So let's say you're working in a company. It's really not term, because it's not like, okay, after this amount of time is no longer valid. So it's not a term. Doesn't meet the definition of a true term life insurance. As long as you are working in that company, that insurance, that life insurance is valid. So let's say you know that, look, you want to take out an insurance that's worth $1 million for your family. If that particular insurance covers you for 700,000, then for the term you can just do 300,000, so that you now have a total insurance. Now, the only disadvantage of that is if you get released from that company, a company-sponsored life insurance expires immediately. There are some companies or some organizations that have, slight variations to that, depending on how much years you've worked for them. You might be able to keep it and things like that. Or if you've worked till retirement, you can keep it. So there are some nuances to that. But generally speaking, those insurance expire once you are no longer working. It's almost like in a carrot to keep people working for an organization, but they expire once you leave the organization. However, to your question, you should consider it as part of the whole while you're still in the organization. And when you leave the organization, if you're not at a point that you have been vested into it such that it carries forward with you outside of the organization, then you will need to bolster whatever you have in your private term life insurance with an extra private life term to meet the total goal. Now, you may not be able to afford, let's say, with the 1 million, you might do another extra 200 to just actually give you a little bit more cushion than the 300 that you have. So that's my recommendation. If you're working with a company that offers life insurance, please take it. Some people don't take it. In fact, so most companies, there will be a coverage, minimum coverage that's, let's say, a percentage or some multiples of your annual income that the company will pay for. And then you can pay an extra, for it in most multinational type companies. I encourage people, those are insurance that you should get. We should not put our families at risk. By the grace of God, we'll live long, we'll have a good health, good life, As a child of God, though, we need to also be responsible and not, put ourselves at unnecessary risk. Things do happen. So I hope that answers your question.
Yes, sir. Thank you, sir.
All right. Thank you. So let's go to the young lady in our last exercise. At the end of that exercise, remember the young lady that wanted to know how much he or she should save, young lady or guy, that will get him or her to $1 million when he or she turns 50. And we used that worksheet that I shared after the class, and we saw that the goal is 650. So the question is, how can I get there? That is what you want to achieve with your budgeting sheet. Let's say, this sheet, I constructed it for a couple. I have another one for a single, but it's in principle is the same. I just added a couple of rows to this one. So let's just use this. Let's say, it's a couple, okay? And they want to have 650 left over at the end of the month. So pay attention to row 56. This is the number that I'm after. This number at the bottom here. I'm going to put a slightly different shade to that cell so that it stands out. This is the goal here. And let's say this individual is still single. Let me actually, since I'm talking about a single person in this example, I'll open my single spreadsheet. So similar spreadsheet, which I'm sharing right now. I believe you all can see my screen. Similar spreadsheet. The goal is this number at the bottom here. This is the net income goal, is what we're after for that individual. It's how do I get there? Is the goal 650. Let's say that individual is earning $5,000 a month. That's $60,000 a year. It's just out of college. So that's probably, not too, I think it's a reasonable expectation, about 50, 60,000, depending on your career or what you studied in school. You might earn more than that or less than that. And let's say this individual really does not have any bonus. So again, remember I said you should make an annual plan. So I always put the annual numbers and convert it to monthly numbers by dividing it. I want to come to the monthly number at the end of the day here. That's why we need to divide and go back the other way. So the individual earns $60,000 a year, but no annual bonus, okay? No other source of income, so those two numbers are zero. So all the income is $60,000 a year. That is $5,000 a month. The taxes it pays, depending on, if you have, I'm just using 18% here for ease of calculation. So taxes takes 10,800 out of this individual's pocket, which is 900 at the beginning. And as a child of God, you're going to pay your tithe. So 10% of your gross income is your tithe. That goes out of the back. You plan for your offering. And as I said that earlier on, we should plan even our offering. Don't just give an offering. How much you should be part of your plan. Okay. So your offering, let's say the individuals has a plan that says, I will be given 5% of my gross income as an offering. Okay. So 5% is 250. All right. I know that Sister Celeste, you were laughing there. It's so true.
Don't just give offering.
They do things without thinking. A lot of people do things without thinking. Don't just give an offering. They call an offering and you just give an offering. Now, you should allow yourself to be led by God as a child of God. Please, I don't want us to misunderstand me. But it should all be part of an holistic thought process. You have a plan. Let's say you budgeted that you give $3,000 a year, as in the case of this individual. How much does that amount to on your Sunday offering every week? Is it $50? And then you have an extra $50 for some other call. But then what if God now lays on your heart to give something? Now you should be willing to listen to the voice of the Holy Spirit, because that's one of the ways God blesses us too. But we should not do that without thinking, and just be moved by emotion. We need to know what we're doing. And anytime you give, you should know, okay, what is the impact on your overall goal, as it were. God blesses obedience, so we need to be obedient. All right, anyway, for this individual, that's the plan. You notice at this point, the total income minus all these taxes brought him already to 4,100. And by the time he takes out his tithes and offering, that will be taken out at the bottom here. We'll come to that. And then medical, all the various insurances, added to it, like 401k. Let's say I want to talk a little bit about 401k. Actually, I will talk about it when I get into investment vehicles in a little bit. But 401k, brethren, you can't afford not to participate in a 401k if it is matched. Now, even if it is not matched, let me explain that term a little bit for those that may not be very familiar with it. Let's say the company says, if you put aside 5% of your income, we will match 1-for-1 up to 5%. But anything beyond 5%, you can still put. Now, how much you can put now is now dependent on the limits that the government has set versus what you have, what you earn, and the percentage and all of that, which we'll look at in a little bit. But if a company is matching at 5%, that is the minimum you must do. Because that 5% is free money that you can invest, tax-free for a long time. I'll show you something in the course of this afternoon also, or this evening. Tax-free investment is so powerful for the long run. It's so powerful, So please take advantage of company offered 401k, 403b is for non-profit organizations, 457 is for like teachers and government workers and things like that. But it's the same in principle, the way it works. You set money aside and you're able to put it into investments. And we'll talk about the various investment vehicles in a second. All right, so we see from all of these things that this guy's deduction, which is your total taxes, your tithes and first fruits and offerings, your insurance, your 401k, everything comes to 2030. So if you deduct 2030 from the initial starting point of 5,000, you're down to 2,970. Now, so that's the starting point. Remember, this is our number here. This number at the bottom, 960, is our goal. This is how you work this kind of a thing. So what can I truly afford? Let's say this individual now goes and rent a house that is $1,200. First off, even from that point, with the other numbers that I had there, he or she cannot achieve that goal anymore. You already just broke the ability to achieve that goal, And then let's say this individual now also decides to eat out every time, so groceries, eat out, go out with friends every time without thinking about it. And at the end of the month, is spending like $600. How much does he have left? $10. Okay. You need to have money for house maintenance. Even if you don't spend it, budget it. Something breaks in the house, the bulb goes out, blah, blah, blah. You need to have money set aside for it. And this individual also is the kind of a person that wants to show that they've arrived. So they bought a car that is costing them $600 a month. Now they are down the whole $340. You see where I'm trying to go with this kind of conversation. And this is not a specific person. I'm just using this to explain one or two things. And then it goes out and takes Netflix, Amazon, you name it, all of these things. So I think there is one called HBO Max. They could take all of these things and it's costing them $200 a month. Keeps digging themselves more into hole. And the sad thing is most people don't even know that they can't afford it. That is the sad thing. Because they don't do this simple calculation. They are negative 540, even though they earned 5,000 to start with. They're already negative 3 or 550. Well, it keeps going. He buys a new brand, and a new iPhone comes out. I need to change my iPhone. I now need to go to iPhone 25 or whatever the number is today. And that iPhone is going to cost you some money, both to buy and to run. Let's say the cost of the service plus, if you buy it, you amortize it, include that number here, as it were, is another $120 a month. Keep digging himself into more and more hole. There is an internet service, he takes it. He doesn't know he cannot afford it. He says he wants 1,000 gigabytes per second. So because he wants to play game, $100 a month. You catch my drift. I'm not going to put more numbers. You catch my drift. This individual is $710 in the hole every month. And then actually, I didn't have credit card here. Maybe he also has student loan that is paying. He had credit card, note. So let's say student loan and credit cards. I'm going to put that. I should have added a line for credit card payments here. So he's paying another $800 a month on that. It's now $1,310 in the hole. We can't achieve 1 million. So what do you need to do? Remember the levers we can pull. I'm going to go back to the presentation. What are the 4 levers for financial freedom? I want somebody to open your mic and tell me the 4 levers of financial freedom, if you don't mind. What is lever number 1? Anyone? Income. Thank you. What are the various types of income?
Active. And passive and portfolio.
Thank you. Hand, passive, and portfolio. What is lever number 2?
Expenses.
Expenses. What do you do with expenses? You control it. You keep it. Thank you. Thank you. You minimize. And then the third lever is savings. Right? It's your expenses controlled versus your income that enables your savings. And your goal is to have 6 to 8 months set aside for emergencies of your burn rates in savings. And then the fourth lever is your investment. Thank you. Thank you, everybody, for listening very, very carefully. Those are the things that helps you to achieve your goal. So in many instances, a young person just coming out of school may not have too much control over the income. This is why I have a couple of rows here. So basic salary will be a hand income. Bonus, again, is a hand income. And then you have other income, maybe other sources of income that in the individual. You can modify this sheet. I'm going to share it with us and add rows that work for
So
you.
the passive and all the portfolio, they all go
Exactly.
in.
Yeah,
Okay.
you add those ones in there. What are the other kind of income? The passive is maybe you have a rental property. That rental property has to be making money. If you are in negative cash
So
flow,
what
then
if you have businesses? Do you
yes,
separate
business is also.
business aside of
No,
this?
in terms of this budgeting, this is your family's budgeting. You have your business budget, but this is your family budget, right? So from
Okay.
that business budget, how much income are you making? You need to reflect it now in your family budget. Does that make sense? If that
Okay.
business is making an income, you have its own budget and all of that. But let's say you pay yourself $350 a month from that income, that business. The others you apply bow into the business. That shows in the statement of the business. But that $350 you pay yourself will now come in here for your family budget. I hope that makes sense.
Is Mumbai awake?
Oh, you're talking about your
Mumbai,
husband?
are you awake? Yeah,
I
I
see
don't
he's
know
on
if
the
you're
line.
here.
I see he's on the line. I saw him log in earlier on. He's on the line.
Nowadays, people can show up, but we're sleeping.
All right, let's keep going. So the first lever is, can I increase my income? Maybe you can, maybe you cannot. Let's assume this individual cannot increase the income. Can you not pay your taxes? No, Uncle Sam is going to come after you. That is a must pay. You have to pay. As a child of God, you have to pay your tithes. Now, there's a little bit of flexibility on your offering. You've budgeted 5%. You can say, well, maybe because of where I'm at, I will pay less. I will do 3%. That's fine. You go in and modify it on the sheet. That reduces your liability, your negative net income a little, but you still weigh down the whole. You need to have all the various insurances. Like I said, term life insurance recommended, but all the other insurances are really required. Okay, your 401k match, put money in 401k to the level that is matched. Beyond that, that's discretionary, but to the level that is matched by the organization you work with. I tell people you can't afford not to. Someone asked me, can I afford to do it? I said, you can't afford not to do it, And then, okay, Star Celeste, I see your hand is up. Go ahead.
Yes. Once when I heard this in the class and I went to my employer and I asked them if they match, we never match. They said, who told you we matched? The lady that answered was like, well, we don't match, but
yeah,
I
not all
still
companies
do.
match. Not all companies match. Some companies do not match, but I still think there is benefit because it's pre-tax investment.
Okay.
You are allowed by the government to still take the money out. Now, you don't get the benefit of free 5%. Let's say they match to 5%. You don't get the benefit of that. But that 5% that you set aside is free, is free of tax.
When it's time for me to take, like at the retirement,
pay it in future. You pay the tax in future, but it depends on your tax bracket whenever you take it out, or how much you even take out. So it's not even like you pay the same tax rate as you will have paid today if you're earning more money. So it depends on how much you take and how much your income is at that point in time. However, the key, Sister Celeste, is the growth of that money. And I will show us a simple calculation that I've shown to show the difference between pre-tax investment and post-tax investment. It can be pretty huge. I'm telling you, because of the power of compounding. So this $130, imagine, the growth of that versus you don't put the money, and not 130, 250 is what it is. You don't put the money and you spend it on something else or whatever, So you may not get the benefit of the company's match, but you still get the benefit of pre-tax growth. I hope that makes sense.
A little bit.
All right. we can ask more questions about it. So but the point I'm making is, even if it's not matched,
just
still
put
do
it there.
Yeah,
Okay.
because you have benefits.
Some companies have like they take it's pre-tax, and some are they're gonna take tax later.
So there are different. I will show you the different things shortly.
Okay.
There are different types, but the basic is pre-tax.
Put it there.
I'll talk through something. Okay, don't worry, I'll talk through it. Now, so you see where I'm trying to go with this is, these are the things you can control, your expenses. Remember the 4 levers, your income. These guys can't control his income. All the government thing, they're going to take their thing. But you can still control some of those expenses. Sister Celeste, okay. So the expenses is where you want to manage, because your goal is the savings so that you can get to investment. This is your goal. These 2 numbers here, your saving and your investment, those are your goal. You want these to be blue, not red. It's red right now. So maybe then, look, I can't afford to live in this house. So if this house is costing me $1,200 a month and I'm just exactly $1,200 in whole, what if I reduce that by 30%? Okay, take 30. Let's say I now get a house that is $800. See, it's gone down from 1,200 in the negative to 800 in the negative. So you move out of that house, you downsize, get a smaller house. You're not competing with anybody. A car note. Should you have a car note? Can you get a smaller car and reduce that payment from 600 to 300? Why not? Again, you're now down. You've digged yourself from 1,400 down to only 500 down. Now, the student loan, you can't do anything about it. But your credit card, you can reorganize how you pay your credit card. Your goal is to pay yourself first. Okay. And I know that sounds cliche if you've heard that term, but it's so powerful. You don't pay the credit card company first. You pay yourself first. That means don't pay your credit card. That's not what it means. It means you manage your, if let's say you have, so this individual pays $300 in student loan. That one you're not going to be forgiven. You have to pay. But the $500 on top of it that makes up the $800 are credit card debts. Okay. How many credit cards and what are the payment requirements? If you make minimum payment, it will prolong it, and then you will be in a situation where the compound works against you and not for you, and the bank makes your money. So what do you do? Let's say that individual has 3 credit cards. One owes $2,000, the other one you owe $7,000, and the other one the individual owes $12,000, totaling about $19,000. You start with the smallest one. Your goal is to pay that one off first, and then you go to the next one, and then to the biggest one. Now, the big one, you make just minimum payment on those to start with. But the one that is the smallest, you pay extra towards the principal on a monthly basis until you pay it off as quickly as you can. Then whatever you were paying total on that small one of $2,000, you don't say, oh, thank God I'm free on this one, and that start pending. You now start adding that into what you are paying as a minimum payment on the other one. The second one, which is $7,000. You apply, if it is $200 a month, you apply that on top of whatever you're already paying on that as minimum until you pay that one off. You kill that one again. Then you take the total money you're paying on those 2 and you apply it to the big one. That's how you take care of credit card debt. You have to I can't say this enough. You have to get out of credit card debt if you want to be financially free. I tell people it is the wizardry of this country. It is the witchcraft of the West that is credit cards.
Okay.
It's why? Because the power of compounding is now working against you rather than for you. And I don't know if you've realized, I'm going to take your question in a minute, Sister Celeste. It's easier to spend money with a plastic because psychologically it doesn't feel like you're spending money. Those people that are doing, why would anybody be begging you to come and take credit card? They know that people don't understand that. You know, psychologically it's easier to spend on a card. So I tell people, don't spend on a card unless you are using a debit card. You need to get yourself out of the place where you are under the burden of debt. You should put cash in your wallet, good old paper money, cash. That's the way you spend, or a debit card. Now, you need to get out of those debts. All right, Sister Celeste, can you go ahead with your question?
Yes, yeah, going to the plastic, it's really wizard. But anyways, so when you finish, I just finished paying off my credit card. Just finished paying it off. And I was just like put my head in wow, like I was happy myself. However, that credit card is attached to the those auto pay stuff that we have.
Mm-hmm.
And then it's building again. So should I just get a scissors, cut it off, or how do you?
Not necessarily. Not necessarily.
So how do?
Don't let it build. How? Pay it off every month.
Every month.
As long as you pay off your credit card every month, they can't charge you because they did not borrow you money. They didn't. You just used the card to make a payment. They didn't borrow you. They didn't loan you any money. You didn't borrow from them. Rather, they didn't lend you any money, to use correct English, right?
Yeah, I know.
So they can't charge you. As I have credit card, it's not like I don't have credit cards, but I pay it off every month. There are certain expenses that it's easier for me to manage by using a single card rather than putting it on. So it's okay. Then at the end of the month, I take the statement, I make the total payment, I break the different expenses back, and I'll show you reconciliation in a minute, into what portion of this budget does it go into. You treat it almost like a debit card. You just take advantage of the ease it gives you. That's it. Pay it off every month. Does that answer your question?
Yes.
All right. Okay, but we still, as this young man, remember what is our goal? Our goal is getting to 650, right? It's still 500. I think let's see how much he is in the hole. It's still $500 in the hole. So he still needs to look for ways to bring his expenses down. Okay, maybe he's been going to Albertsons to shop, or one of these big grocery store shop. Okay, he has to probably look for another one and cuts down on expenses. There's a line item that I don't have here. I think I might have it on the other one for couples. It is clothing. You should budget. Okay, I have it. Sorry, this is it. You should budget even your clothing. You should not just go to the store and say they are doing, what do they call it again? Sale. I tell people there's always sale. Since I've got into this country, they've been doing sale, and they're still doing it today. The same store, they will increase the price. They bring it down tomorrow. They tell you they are on sale. It's the lie. It's one of the biggest lies in this part of the world. Okay, so don't buy because it's on sale. Buy because you planned to buy it. Okay, back to the individual. Okay, maybe you can cut out your eating out, cut down on your expenses, buy in bulk, go to Sam's Club, go to Costco, buy in bulk, and bring his expenses down to half of that. It's now only $200 down. What else can he cut? He's been working on this. He has to figure out a way. Really, this guy is not going to be able, I don't know how he's going to be able to achieve his goal. Okay, stops taking toll, so he drives only on the regular street, so another $100 down. Miscellaneous expense, find a way to cut it to. All of the, Netflix, HBO Max, cut all of those things off. Get on regular internet, there's free TV, there's free YouTube, zero. Now is back into the positive, hallelujah. Now is back into the positive, $90 a month. Our goal is still $650. So it's really going to be tough for this individual to get to that goal.
How
But
about Netflix and Amazon? The Prime. We need Prime, bro.
who
Right?
told you you need it? You don't need it. It's not
Okay,
a
so
need.
explain the
You
Prime
want,
for me.
you want
Because
it. You want it.
so
You
that the
don't
thing can
need
get
it.
to my house faster. I need, like, I'm a teacher and I
My
need this
sister,
material.
you don't need it.
Okay,
You want it.
oh wow.
Go to if you need to use Amazon, use Amazon. You don't have to have the Prime. Now there are some benefits to it. You don't have to have it. If it means going to Costco and not having Prime, go to Costco, please. Very, very important. I know I'm saying these things and it sounds funny. It sounds like, but I'm telling you, this is the only way to manage yourself. Be honest with yourself. Be truthful to yourself. What can I truly do? What can I truly now? This is a single person that's just starting out. Okay, I see your hand up, Pastor. Please go ahead.
Right. So there's no way that we will have a budget without, just enduring some pain.
Mm-hmm.
So that's one thing I just want to raise up.
Thank you, sir.
I mean, Prime is good, Netflix is good, but we would endure some pain to get on.
Thank you, Pastor. I appreciate you saying that. See, this is where I find people struggle. They don't want to take that pain. They still want to eat their cake and have it. Life doesn't work that way. And I think I shared something on our WhatsApp. There's a book that I'm reading, and it said something. It said, you either play now and you will pay later, or you pay now and you can play later. Regardless, nothing is going to be free. You are always going to pay. It's either going to be now or later. You pay now so that you can play later, or you play now, you enjoy now, and you are definitely going to pay later. Many people are in their 60s. They can't even afford to stop working. They have to keep working. And at that stage, your strength is not the same as when you were in your 30. And then they may not even, if you've gone well in your career and you're at like a leadership role, whatever, it's okay. But if some people are just working and still earning something that is even not as good as they were earning earlier, because the younger people have now come in and they are delivering at a different level, and they are struggling. Now they are paying when they should be playing. I hope this makes sense. Let's just keep going. This individual now say, look, even this house of 800, I can't afford it. I need to move to a different place. I'm going to pay 500 now a month. I'm almost getting to my goal. I'm now 400. My credit card, I've paid it off to the point that I'm now paying only the student loan, which is 300. Hallelujah. 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 Now I have $890 a month. Don't even start your investing until you've paid off those credit cards, because it's just going to be working counter to you. It's not helping you. Pay those things off and then you start. The earlier you can get those out, the better. Now I have 890, and I now can come to the bottom here and say, look, out of this 890, remember, what is our goal? Our goal was 650. So let's assume that I can actually let's go back actually and do a little bit of simulation here. I've achieved my savings goal, so I don't necessarily need to keep more to savings, so I'll just put 0 on that for now. I'm going to now put 800, now 650 as my goal. But the car that I'm driving, I want to get out of paying a car note. So I'm going to start paying off that car. Or if it's already no note on it, I'm going to start setting money apart to buy my next car cash. You should buy your car cash. You don't have to buy a new car. You don't have to buy a new car. You can get, the moment you drive a car off the lot, you lose about 20% of its value, like that. Now, I drive a new car, but I've not always driven a new car. So I'm not saying you can't drive a new car. Please understand me. But there is time. There is time for everything.
Amen.
People are buying cars that they can't afford. I have an instructor when I was in business school. He said he just came in through the parking lot in the business school. And you know what he said? He taught us entrepreneurship. He said, all of you guys, you are driving your future. He said he looked into the car in the driving student parking lot. He saw big cars, brand new cars, and he told us, you all are driving your future. And that thing stuck with me since then. You know, you should, if you set apart even as little as $150 a month, that is 1,800 a year. Do you know that you can buy a good car, not brand new, for $3,000, $4,000, $5,000? And it's not going to be a car that will give you trouble. Cars that will give you trouble are those cars that, you know, already have an issue, $1,000, $2,000 car. But
I'll be calling you. I need one right now too. That $5,000 car.
You see where I'm going with this?
Yes, sir.
Nothing says you must drive a new car. Nothing. You don't need to impress anybody.
Yes.
When the time comes, God has helped you, your children are out of school or whatever, you can afford it, great. But before then, you don't need to. If this individual has a car note, in this case, if he doesn't have it anymore and it's now zero, look at what it does. It's now $1,190. He can then say, okay, for my car replacement, I'm going to start putting $250 a month so that I have this car now and I'm going to make sure that I'm ready for when I need to replace it. Yet I can achieve my goal of $650. In fact, I'm going to do a little bit more. I'm going to do $750 because I have been able to have a net income of $1,190. And despite the fact that I'm putting $750 into stock every month, I'm putting $250 aside to replace my car. I'm setting money aside to buy a house after 3-4 years. Despite the fact that I'm doing all of that, I'm still $90 in the positive. I can even increase this money that I'm going to put towards buying a house so that I can save enough to do my 20% down shortly. You see how to think about this thing. It's still less than the amount he has saved. And now he's now able to go back into his modeling sheet and say, look, I can do $750 a month. And rather than having $1 million in 25 years, I'll actually have $1.2 million. Wow. Hallelujah. You see, this is the way to think about this thing. And I hope this makes sense. Now, let me do one more thing on budgeting. After you've made the budget, it's important to reconcile, because if you don't reconcile, you're not going to know if you are meeting the goals that you set. So I have added to the sheet a January to December reconciliation section and added a summation in column R. Even added percentages to it to help you learn. And then the difference is here, that is the difference between your year-to-date actual and your plan. Very simple, good spreadsheet that you can use. Let's say for the month, I'll just use this row that I have filled. We're in April right now. He earned 5,000. He didn't expect to make a bonus, but he got a bonus. Anytime you get a bonus, it should go towards your investment or taking part of it to pay off a loan, to kill the loan as quickly as you can. And then this is zero, or maybe he now has some other income, whatever. Put it all in there. But all the monthly expenses on all of these things, go back and put the actual numbers back in there. And the spreadsheet will help you to calculate. Now, these are just numbers that I was playing with, so it may not match anything. But the spreadsheet will help you to calculate, what your total expenses are for the month and what your net is. The net is high here because it made a big bonus. Let me put the bonus at 0, and you can see that it's netting 746. That is, if he did something, must have prevented him from achieving this goal. You can see, let's see, the rent was more than that. It still has the car note. So anything above your plan will throw you away. So throw you off rather. That's why you want to reconcile. And you do that on a monthly basis, at least once a month. I tell people at least once a month. Not everybody might really like numbers, but you need to get more and more comfortable with numbers. We do ours every week. I know not everybody feels comfortable doing that, but I actually look at it. I've been doing this for years, every week on a Saturday in the morning, or if I'm off on the Friday, I'll do it on the Friday. Every week I reconcile, be sure I'm where I ought to be. Okay? They say in my where I come from. Sorry, let me just say a proverb, Sister Celeste. They say where I come from that it's only half of you know, a bar, half of a bar, not even a bar. Aboro. It's half of a word that you tell a wise child that when it gets into his head, it becomes a full word. You know, people jokingly say it also that it's half a plate of a bar that you give someone, that when he eats it, it will become a full plate. That's just a joke. I see a hand. Yeah, Pastor
It's just
Sister
like
Celeste.
for a wise person, one word is enough, right?
Exactly. A word is enough for the wise. That is what it means. A word is enough for the wise. Yeah, Pastor, you like to.
What I was about to say here. Okay, bro, Larry, I download your budget. You shared it last time, and I tried to and I was working on it. So to add, you mentioned that you add column R and S. So
Okay.
yes. So this is the new format, right?
No, it's the same. It's the same one that I gave you. If you downloaded the budget sheet, I've not shared the budget sheet in this series of class. Maybe I shared it with you directly based on some conversation we've had. But I'm going to share it after the class. What I shared after the last class is this one, the future value worksheet. I don't know if that's the one you are referring to.
No, sir. It is some.
Okay.
Yeah, the other
one. The one I probably shared with you is the couple version, so that you and Brabumba can work on this.
Yes. So it does it.
It's the same. It's the same. The only thing is I added a couple more rows on this because of a couple, they will have more things and stuff like that. I added the husband and wife income. You can also include rows for yourself, but the columns are the same. You know, R is
it
R.
will not mess up the because you're using formula. The moment I'm adding rows,
if you had row,
I mean, I think I have to go to.
Let me show you. Let me show you. That's a good question.
Another lesson. I mean, another course to get familiarized with some of
that's
those
a good question, Sister Celeste. Okay. That's a very good question. How do you add rows and not, mess up the spreadsheet? It's very, very simple. This is the couple one. For example, let's say you have a business. This couple have income, husband and wife, and then they have a business. Bonus may not be applicable to you, but you have other income. Let's say you have real estate. You can, go to the right here. Yeah, you just right click and say insert, right? And say maybe you have a rental real estate. Just type that in there. The key thing is, remember I said I plan from an annual point. Now, if you have an idea how much the annual say cash flow, positive cash flow from that house will be for the year, let's say is 4,000 for the year. Okay. If you draw down the formulas in these orders, it will bring down every other. It will sum everything for you. So it calculates this as that divided by 12. That percentage is with a fixed dollar character that I'm using to make sure it's fixed. So it calculates as 2% of your gross income that is from that real estate investment. Then you go to the right here also and you draw down the formula. The moment you do that, everything is back to normal. Does that make sense?
Yes, sir. Thank you.
Good question. Now let's go back to this. And that really is what this is talking about. You're preparing your budget. What amount do you have left to invest? That's the bottom of that sheet that we were working with earlier. This is the couples one. Going back to this one, that's really talking about playing with these numbers. I'm using the word playing. I mean really working with these numbers. until you get to your goal. You remember your goal you set with this spreadsheet. And then you come to this other spreadsheet, and then you plan your goal. How do I achieve that goal? That's what you're doing with the budgeting spreadsheet. What do I need to cut? What do I need to? And if as a couple, you should do this together, because sometimes what I've experienced with some couples is that the husband is the only one that does this, and the wife feels like it's just trying to use a budget to punish me because I want to buy this thing. He's saying I shouldn't buy it. But if you do it together, now the husband or the wife might be the one that prepares it initially, but as a couple, you sit down once a year at the minimum, and you look at what is our plan financially for next year. What are the incomes that we expect to make? What are the expenses that we expect to have? What are the even family expenses? And I mean this, like those of us that are from Africa, we need to help people at home. You need to budget what you're giving people at home. Don't just send money. And then you, as a husband and as a wife, you need to be on the same page with whatever that amount is. The husband should not be secretly sending to the family or the wife. If you do this together, it's so powerful. And then the wife is not thinking he's hiding money somewhere that he doesn't want me to see, because you all know what you can afford. If she says, if I go back to the example of the single, I know we're talking about couple now, but I have numbers in the single spreadsheet. Let's say the man tells the wife, look, we need to leave that $1,200 house, downsize to where we can only be paying $500 if we're going to achieve our goal. She knows where you're coming from. If the man says, look, what we can afford for clothing, I know this is a small amount, it's $360, which is only $30 a month. That means you can't go to JCPenney, so you have to go to Walmart. The man knows, the lady knows, and you're not fighting and working at cross purposes with each other. I hope that makes sense. The power of this is to do this as a couple. If you're a married couple, sorry, I was just changing the AC thing there. All right, let's move forward if there are no questions on that. Now that I have been able to save, remember, these things are all in a loop. Where do I put this $750 that I've now been able to set aside from my budgeting, and I'm making concerted effort on a monthly basis to make sure that I can truly achieve? What you need to do first of all is you must have different accounts for different expenses. Your checking account should not be the same as where you're saving money. Your checking account is a checking account. It's just where you get money in and where you pay bills from. It's not a savings account. You need to have a savings account. You need to have a stock brokerage account. We'll talk about that quite a bit later. If you have a goal that you're saving towards, like you want to replace your car after 3 years, or at least it doesn't mean you will replace it, but be able to replace it if you want to. You should have a goal account that you set up that you can start putting that money into. If you want to have money set aside for down payment, whatever it is that makes sense to you, you should have an account for each thing. You can combine these two because they are kind of goal account, car replacement and home down payment. That's okay. Like you don't have too many. And the beauty of these new banks is you can do all of these things online in 5-10 minutes. If you already have a main account with, let's say, Bank of America, you can open another account that's for saving. You can open a goal. There's another term they use for it, a goal type account. In the same, so you have a mother account and you have all this stuff, and you can move money in between them very, very easily. You can set up automatic transfer between them, even between your checking account, your savings account, and your investment account that's with a different bank. You can set up automatic transfers. The more you automate this process, the better, because it takes the power away from you. It puts the power in the hands of tools that can help you achieve your goal. So now that we've done all of that, we've figured out how much we need, we've figured out how we're going to get there, what do I put this money into? So we won't, because of our time, be able to do all of the investment vehicles tonight. I can see that already, but I will start talking about it. Sister Celeste, I see your hand. Go ahead.
Yeah, just one question for having multiple banks. Should we, I mean, sometimes for convenience, if you having a credit union or having a regular bank, or is that is that something
Well,
that you
yeah,
can reframe ourselves, or is that okay, or is
not the issue is not different banks, it's different accounts. You can have different accounts within the same bank, within even the same portal, have multiple accounts. Now, the beauty of like a credit union is the credit union is, generally speaking, working for the interest of their members. Okay, so generally speaking, you might get a lower interest rate credit card from a credit union. A better, if you're going to take a card note, a better, interest on the card note and things like that. Okay, but in principle, it's the same. I wouldn't want to say you should use a credit union over and above a regular bank. It depends on what you get from that organization. Generally speaking, credit unions will give you better terms.
Gotcha. Thank you, sir.
Yeah. Excellent. So the question is, where do I put this money? It's a list of about 12 things here that I will talk through. There is no way we can get through all of it today, so we'll continue there the next time. I might actually have to add another session. If you've been following what I've been sending out on the WhatsApp, I will teach advanced investing. I'll find time. I don't have that schedule yet. My schedule is a little bit busy, but I will find time to teach maybe 2 classes on advanced investing. I had someone actually speak to me a little bit this week along that lines. I've shared one of the classes that I taught on that in the past that talks about stock, a technical analysis. Now, to be an investor, you don't need to know technical analysis. You don't. Okay, if you follow the things that I will teach, I've been teaching, and I will teach this class, the next class, and then I might add one more class to this series 6 session, because I like the participation and I like the question and I don't want to rush it. So rather than finishing it in 3 classes, I might add one and finish it in 4, which is fine. If you do what I teach in these basics, these fundamental, these 3 or 4 classes, you will be good. Now, if you are interested in learning more, remember I told us that a lot of these things has to do with language, the lingua. They can bamboozle you easily if you don't understand some simple terms in this industry, in the financial industry. So one of the goals there is to understand a little bit more in-depth technical terms within the financial industry to give you a little bit of an edge. Now, if you're also interested, watch the video that I shared on technical analysis. It's just one of the videos of the class that I've taught in the past. There's a depth that you can get into that if you use it, if you actually have time to do it, it can give you some edge over someone that doesn't have it when it comes to this regular basic investment that I'm teaching. So for those interested, we'll do that. We'll find time to do that 1 or 2 classes later in the year on advanced, the advanced class. But again, you don't need to be in that class to be an investor. What I'm teaching here is more than sufficient because it's focused on the long term. All right. There are 12 investment vehicles. I'll start by talking through what I have in the bottom right. That there are 5 common asset classes. There's what is called equities. Equities generally are like stocks or some investment that has stocks as their underlying investment tool. And I was teaching a class. I wish I actually had that slide from one of these class, not a class. I was invited to talk about this to the Nigerians in West Texas community a few months ago. And I had a slice and I explained that it's like a stock is like a slice of a company, a slice of a pie. There's a pie, which is the whole company. When you buy one stock, you have a tiny slice of that pie. So that's what equities are. And then you have fixed income securities. This is where things like bonds fall into. Then cash. That's another asset class. Now, when I say cash, it doesn't mean paper. It means money that is functioning like cash, like money markets. That is the equivalent of cash, or like CDs. Those are really cash investment. They're almost like having cash. And then you have commodities, things like gold and stuff like that. And of course, the fifth most common class is like real estate. Those are the various, classes of assets that you can invest in. And all of these things that I talk about will fall into one or so of these categories. So the first one is your individual stock, which is what I just explained. It is simply having a piece of a whole company. I tell people, how many of us have a phone? I'm going to maybe put us a little bit under pressure right now. How many of us have like an iPhone, Android? I think everybody is in this class has a phone. Everyone. I'm almost sure about that. But if I ask us, and I'm not saying you should answer this question, how many of us has an investment in a company that produces a phone? I'm not sure how many of us will say we do. You should not have an iPhone and not have an investment of Apple. You should have at least one stock of Apple. The moment you do that, you become a part owner of this phone. It might be 0.000001 of this phone producer that you have, but every 0.001 of that company's net income is yours. That's the way you want to think as an investor. You don't have to be big. You just have to start. If you have an Android phone, whatever company makes it, you should have a stock of that company. And it's not difficult to invest in stocks. They make it sound as if it's difficult, as if you need to have a professional. I will talk through some of these things. It's pretty simple. The first step is you must open a brokerage account if you don't have one already. I can't say this enough. It's like, and I used this illustration in one of my classes, and it, I think it resonates. I don't know if you've noticed this. If you drive a particular type of car, you start seeing that car on the road. It's not as if that car or that model was not on the road yesterday, but simply because you were not driving it, you did not notice it. I drive a particular kind of car right now, and I'm surprised how many of it are on the road. It's called the law of attraction. The law of attraction. Your mind is going to go. In fact, the Bible says where your treasure is, that is where your heart will be. If you want to be someone that starts becoming very familiar with stocks and investment in this market, you need to start by buying your first stock. I'm not talking about your 401k, your own first stock that you buy by yourself. So if there's anyone on the line that has not opened an investment account, please, I'm begging you, please go and open one tonight. You can do it online. You don't have to go into anybody's office. You can do it online. Open an investment brokerage account. There are a number of companies, and I think I have a list of some of them on this that I can share with us later. Companies like Fidelity, Charles Schwab, there are many of them. They are called discount brokers. In the past, I remember when we moved to the US, this was late 90s. Then we came to the US originally. We opened Schwab, and for us to trade a stock, you actually have to pay some money for every trade that you execute. But the company like Charles Schwab are the ones that they've liberalized it. They've made it so easy. In fact, today you can buy and trade without paying anything. Now, if you do it too often, there's a cost to that. We'll talk about that differently. But it's so easy to open a brokerage account, and everyone on this call, please, if you don't have one, open one tonight. So those are individual stocks. A stock is a piece of a company. That's all it is. Some people call it a share of a company. Mutual funds and index fund, I'll talk about those together, almost together. Mutual fund is really a publicly traded group of stocks. So let me explain it this way. A company, if I want to buy Apple, the company that produces this, the share of Apple, let me see how much it goes for today. I think a share of Apple is about, let me see, I have it on my phone. Let me just quickly look at it. A share of Apple right now goes for 255.92 cents. You know, brethren, I know when they sold a share of $2, less than $10 some years ago. But anyway, this same Apple has sold, I think, as high as around $600, $800 some time ago, maybe even higher than that. And then they did a split. It came down to like $100 or something, $60, $70. And currently it's selling around $255. Okay. If I want to buy one share of Apple, I need to have $255 or $256 to round it up. But with that $256, I could actually own a portion of Apple plus many other companies. Because there are companies that pull those stocks or those companies into what is called a fund. A fund is managed by an organization. They call them a fund manager. They will have an individual that manages the fund. And what they will do is they will put different companies into that bucket. So when you now invest your $256, instead of just buying one share of Apple, you are going to buy a fraction of Apple plus a fraction of all the other companies in the mutual fund. Which, what that does is it reduces your risk. You are not only exposed to the performance of Apple, you are now exposed to the performance of all the companies within the fund, which is good. It's one of the ways to lower your risk when it comes to investing. Now, the mutual fund is different slightly from an index fund because a mutual fund is actively managed. That is, the manager of that fund can say, look, today I have Apple, I have Microsoft, I have Walmart, and I have Tesla, 4 companies in my fund. Tomorrow, I don't like Tesla anymore, so I'm going to stop buying Tesla. I'll sell all the Tesla shares that I have, and I will now replace it with Texas Instruments. I still want to keep 4 companies, but I'm no longer going to hold Tesla. That process will cost you money because once they sell that stock and you own a portion of it, in a sense, there's a tax due which will affect the performance of that fund and really is indirectly affecting you also. It doesn't mean you pay that tax, but it is affecting you because they are taxed for paying depending on how long they held it. Okay. And that process of buying and selling and researching and finding what they want costs money. Okay. And as a result, there are fees, that needs to be paid. Let me go ahead and maybe step a little bit into some detail as I explain all of that. I've talked a little bit about stocks, so I won't, dwell too much on it because I already did. So, but as I said, it's a part of a big size or a big pool of the company that you're buying when you buy a stock. Okay. There was a study that was done by Charles Schwab a couple of years ago that, I just want to quickly comment on. Most people, they think, they want to beat the market. They want to perform better than the market. So they are buying and selling and doing all of that, And that study kind of looked at 5 people investing $2,000 a year per year for 20 years, starting in 1993. So the total contribution was $40,000 because they all do $2,000, dollars a year. For all of those 5 people, they looked at the individual that invested the best, that came in when the market was low and sold, got out when the market was high. At the end of 20 years, he invested 40, but his market value was 87. That is, he perfectly got it right. In at the best time, out at the best time. The investor with the worst timing that always came in at the height of the market and left when the market was low, he still left with $72,000. The one that kept cash, the individual that did not invest, he only made $10,000 or $11,000 more. That is, the moral of that study that was done is, even if you don't get in at a good time, you're still way better, $22,000 better in that 20-year period than the guy that you're so afraid I didn't do anything. So I tell people, you don't wait on the sideline. You miss 100% of the shots that you don't take. 100%. You miss 100% of the shots you don't take. Your goal when it comes to stocks and all of these things that I'll be talking about is two things. Please write this down. It's called asset allocation and diversification. They are two separate things. Asset allocation talks about the kind of industry, or the kind of, not just industry, the kind of type of asset. Is it fixed income? Is it an equity? The kind of asset it is. And then diversification, that is, even within the same asset class, let's say it's stocks, you are looking for companies that allows you to be diversified across various sectors, globally and within and across different asset classes. And what are the things that allows you to do all of that? Again, that is part of your risk management overall strategy, and we'll be talking more and more on all of these things. And I always say this, that you can't win by sitting on the bench. It's just as with anything in life. Fear is not rewarded. Fear is never rewarded. Courage is what is rewarded. If you operate in fear, you've lost the game even before it begins. Risk, I tell people, comes from not knowing what you're doing. And you're taking time to go through this class, you're learning, so you are much more educated than most people. And the key thing, and I kept saying this almost from our first class, is that you should not maintain a short-term view, because with the ups and downs of the market, you will lose in a short term if you maintain a short-term view. And don't invest in people's ideas. Don't go and say, as they say, this thing is what is selling today, so I want to go and put my money in it. No, you invest in proven businesses that have made money and have a proven track record of making money. I started explaining mutual fund from the summary sheet. I just want to, instead of staying on the summary sheet, delve in a little bit more with the detailed sheets. A mutual fund, I've explained, is really a company that pulls different companies into what is referred to as a fund, so that you're buying pieces with the only money, instead of just buying one company and exposing your risk completely to that company's performance. You spread your risk across multiple companies. Now, the challenge with mutual fund is that it is actively managed. Remember that word tonight. It's actively managed. That is, they are constantly looking at taking out a company and bringing another company into the fund. That process costs you money in taxes and other expenses. That's what they call a load. How a mutual fund is priced, since it's not just one stock, it's priced using what is referred to as the net asset value of the stock. They put all the price of the stock together and divide it by the number of stock. That's all it is. So let's say they have 4 companies. I'll just use that. I'll say Apple was 256. The 3 other companies that I mentioned earlier on, it actually cost them $1,000, and they now have 4 shares. But what is the cost of 1 share? Because it's now one fund that you're buying, but there are 4 shares in it. So since there are 4 companies, say the total cost is $1,000. If you divide it by 4, the price of 1 then is $250. That's the way they kind of calculate net asset value in simple terms. So the net asset value is like the stock price for that stock. But it's not just one stock, it's that like the fund price. All right. I wanted to make a distinction between an index fund and a mutual fund. The key distinction is that index funds are tracked to an index, such as S&P 500. S&P is an acronym for Standard & Poor. I don't know if you've heard that term before. You probably had Dow Jones. That's the one we hear all the time. Dow Jones is an index of 30 companies, the 30 largest companies in the US. That's what Dow Jones is. So all the companies that forms those largest 30 companies, they don't change like on a day-to-day basis. It remains the same. Over time, if a company's performance falls out of the criteria to remain in the fund, it will be taken out and replaced by a company that meets the criteria. So you can see that since they are not going to change it, there's no need to trade anything. You just buy those 30 companies, that is the index fund manager, just buy those 30 companies and that's it. So the cost is much lower than a mutual fund. That is the key distinction between a mutual fund and an index fund. I always encourage people to invest in mutual fund. And that's why I was saying earlier on that if you follow what I'm going to be teaching, you can achieve your goal without going to a technical analysis class. You don't need to figure out how to buy a stock. You don't need to figure out how to buy anything but an index fund, honestly speaking, when it comes to stocks investing. Now, I like stocks because there are some benefits of owning stocks. Once you get into an index fund, you kind of diluted a little bit down than if you own individual stocks. And then if you do your analysis well, you can actually make good money from the performance of a good stock that you selected. So I encourage people to have either you have an index fund and stocks, individual stocks, or you just own index funds. I always try to discourage buying mutual funds because of the cost associated with owning it. Okay, please feel free to slow me down if you want to. And I explained how to calculate this. I won't dwell too much on it. It's essentially your net asset value, which is what is used to price both a mutual or an index fund. That is the total assets of the company minus its total liabilities, all the stocks that they own, minus whatever they hold, divided by the total number of stocks that they buy, is their net asset value. That's how funds are priced, index funds and mutual funds. The portfolio turnover rate, yes, Sister Celeste, go ahead. You're muted. I can't hear you.
Sorry about that. You mentioned no load mutual fund. Like, okay, well, first of all, the mutual fund, you encouraged index funds and stock. Are they also are they no loaded accounts for that?
Yes. So a load is just a term for, let me say, I think I defined it in here. A load is a term for the cost of managing the stocks. That's really what it is.
Okay.
So
yes.
If the company has less expenses, their load is lower. Really, that's what it is. And there is no encumbrances as much encumbrances to them. Okay, so you have a fund that has no load or low load.
So with the index,
yes,
within the index fund, we have a load or no load?
So usually it's mutual funds that will have a load because they are the ones that tend to have costs, significant costs. Index funds are by nature no load.
Okay.
Because they're not trading. Their costs are really very limited. So their load is very low. Does that make sense? Whereas
no load at all.
Fund, will have either low load or no load. The portfolio turnover is how much of their assets they sell and buy new things every year. That's a portfolio turnover rate. So if the company has a total asset value, they call it asset under management of 100 million. If during the year they sold 20 million and purchased, other stocks, then their turnover was 20%. These kind of things will cost you money from a taxation point of view. It impacts you, not directly, but it does impact you because they are trying to beat the market and they're costing you money in the process because the profit they make should accrue back to you, but if they pay it as taxes, it impacts you negatively. The expense ratio is how much or how little you're paying, for them to run that company. And there are different elements to it. You have your management fee that they will pay whoever is making that decision of what they buy, what they don't buy, company, whatever it is, right? They pay for that, those kind of things. The people that work, their secretary, you pay for that. The advertisement that they make, you pay for that. And you, even if they don't make any, they invest your money in something that doesn't make any money, you're still going to pay for these things. So you want to check that the expense ratio of the stock, the fund rather, that you are picking is low. It's very low. And I'm going to give us an assignment, maybe not tonight, to look at that. Did somebody raise their hand? Oh, okay, there's somebody in the hallway. All right. I will not spend too much of time talking about gross and net expense ratios. It's simply just talking about, expense ratio minus, things that are kind of temporary, or things that are really part of it, as it were. But the point I want to just keep in mind is that I don't want you to invest in index funds that have a high expense ratio. Your goal is to keep the expense ratio as low as possible. If the expense ratio is more than 0.5%, it's costing you too much money. It's costing you too much money, because remember, that money will not be able to compound for you anymore. Most mutual funds, expense ratio is greater than 1. But index fund, you can have index fund of 0.01, 0.02. That means the cost to you as an investor is limited. The more the expense ratio, the more they spend on all of those things, the less money is available to compound for you as an investor. Okay, so I'll just leave that. And then, I think I talked through this quite a bit already. The high expense ratio of a mutual fund is what makes it not as desirable as the expense as an investment versus an index fund. And what causes it is the fact that they are constantly trading. Okay, that's what causes them to have a higher expense ratio. That's the downside. They have a higher turnover that will cost you in terms of taxes. So I generally steer people away from mutual fund. I would recommend index fund, because you're going to achieve the same thing, but even in a better fashion. The goal of spreading your risk, you achieve it with an index fund. The only thing is they are not trying to beat the market and perform better than the market. And like you saw in that example of 5 people that Joshua did, even if they beat the market all the time, the difference is not that much for the person in the worst place scenario. So what are you achieving truly by trying to beat the market? Beating the market is, they call it seeking alpha. They're seeking alpha. The market performance is referred to as beta, but above market performance is considered alpha. So their goal is to seek alpha. What this slide is showing us is the impact of the true impact. I think this is where we'll stop tonight, and then I'll open it to question. The impact of fees. I can't say this enough. I want you to use index funds, not mutual fund, because of this reason primarily. If an individual invests $50,000, in this particular portfolio, and the gross return is 7%, that's what it is. If the expense ratio is 1.25, that is, out of that 3,005, 605 is taken out of your money that you made. These 3,500 you made, they made that gross return, but they take out 61 to pay their AC, to pay their electricity. Their trading cost, the cost of constantly trading, maybe another 1.2, another 615. That means your net return goes down from 7.11 to 4.65, from 3.5 to 2.3. Your true fees is the sum of all of that divided by that. That is, a third of this money that you made is lost. And look at the impact over time on the left frame of this screen. I don't know if you can see. Let me use a mouse, a pointer. I think I have a pointer here that can make you. I hope you can see this. The top line here is 1% annual fee. The next one is 2%, and the next one is 3%. This is the impact of investing $1 million and assuming an 8%, annualized rate of return over a 30-year period. That 1 million after 30 years will be 7.6 million if your annual fee is just 1%. But if it is 2%, it goes from 7.6 to almost losing 2 million. If it is 3%, it goes down even further by another 1.4 million. So the difference between having investing in a fund that costs you 1% and one that costs you 3% is 7.6 minus 4.3 or $3.3 million. That is huge loss to you. And the reason is that this 2325 years, all that is compounding. Now, these are two, it's not saying I'm talking about this 50, this left is talking about million. But my point is this extra 120, something 1,230 that is taken out of your money, because it doesn't compound, is now costing you this kind of return. That is huge loss over time. Huge loss over time. So please, fees is your money that is not allowed to compound. So you need to keep your fees low, is where I want to really end that. I will stop there tonight. I really, there's a lot more to share, but in the interest of time, I'll stop at this point tonight and see if anyone has any question. Yes, Sister Celeste, I see your hand is up.
Yes, and the law that you're talking about is the one you mentioned, 0.01 or 0.02.
Yes,
so when a broker or any financial person comes and wants to, get you into it, in my head, I have to ask them, like, what is your expense ratio?
Good. What's the expense ratio? Less than 0.5 is your goal.
Less than 0.5.
So you can achieve less than 0.5. You can even do better than this top line here. Most mutual fund is going to be between 1, greater than 1, between 1 and 3. Some are even higher than 3. You won't believe it. But that's mutual fund. Index funds are usually less than 1. But the lesser it is than 1, the better.
Because if you get a, with an account that is managed by, because I think an agent from Primerica, an agent for Primerica was talking to me about mutual funds, but I didn't have the knowledge that I have myself. And of course, as an agent, so, you get me into it, to get the license, and I was able to get I was able to read the book and pass the license. So I'm still learning. And as an agent for like life insurance, they want you to also have an account. They encourage, in other words, they will encourage you to have an account for yourself. But I didn't have the knowledge that I have now. I have to go back and ask what is the expense ratio, and so.
And I can spend some more time with you. We'll talk through some of the details of what this individual is asking you, and help guide you along that lines. See, anyone that comes to you with those kind of things, be very leery about them, because something behind their mind. So you need to be very, very leery or careful. So, but I think you're getting the key point here. Your expense ratio must be low, preferably less than 0.5% point. That's your goal.
Yes.
And you can typically achieve that with most index funds because it's not actively traded, Pastor.
So thank you so much for spending the time with us tonight. I really appreciate it. 3 things I wanted to talk about quickly. 2 questions and then one maybe one observation.
Yeah.
So the question is, so the ETFs right? They are index, right? They are index funds,
Mhm.
all ETFs.
Yes.
Because you know that they just have very low expense ratio, as you mentioned.
Mhm.
And I mean, it's a piece of every company. Once you buy it, you just leave it alone. You don't have to manage it.
Yeah. Now, the disadvantage of ETFs is the pace of trading. They are not index funds, they are mutual funds.
They're much okay.
Yeah, they are mutual fund. And they are traded at the same speed as a stock. In fact, mutual and index fund, if you put an order in for a mutual fund today, they don't buy it. You don't know the price until the end of the day because they are trying to figure out what is the average buy sell price for that stock for that day to
Okay.
decide your own price. So it's like the rate of trade is low, the velocity of money is low, both in index and mutual fund. What is negative in mutual fund is that they are still selling it on a daily basis. But ETF is even at a faster pace. It's at the pace of stocks. I mean, stocks are traded in microseconds. You won't believe this. We have a trading account. I have that ability to kind of see even what they call market depth. How much fast, how quickly these things, it's like faster than you can blink your eyes. Millions and billions of dollars are moving around between stocks. And the same thing is happening with ETFs. It's traded at a very, very fast pace. That's why it's called electronic traded funds. Now, it has an advantage of multiple companies. However, it has disadvantage of frequent trading or active trading versus an index fund.
Okay. Okay. Thank you for that, sir. The second question is regarding traditional IRA and Roth IRA.
Mm-hmm.
So my question is basically the backdoor. You know, the backdoor
Yes.
function.
Yes.
Is there a way that you can help with that? Or
yes, I'm actually, time will not let me get to that tonight. It's one of the things that we're going to be talking about. Because once your income gets to a particular level, you are not allowed to put it into Roth IRA. But you know, the people that made the pencil, they're the same people that made the eraser. So they created what they call a backdoor IRA. And I will explain it in detail the next class. But really, it's almost like it's a taxation process that allows you to take money, you know, and put it into the fund. And it behaves like a Roth IRA. Now, for the benefit of those that don't know what a Roth IRA is, we'll talk about this very, very well next time. But a IRA generally is your individual retirement account. The money that you put into IRA, generally speaking, it goes into a traditional IRA, which you invest post-tax money into. But there was a law or a Senate person many years ago that proposed that, look, not a lot of people make a lot of money. Why are you taxing them and all of that stuff? And then they created a Roth. The guy's name is actually Roth. So they created Roth IRA, which you can put money into pre-tax because of the benefit of pre-tax then. And I will explain that more some other time. But they put a limit to it because they don't want, well, in quotes, rich people to benefit from it. They want only those that don't have up to a particular limit to benefit from it. So what did, in quotes, rich people do? They created their own Roth IRA and they call it backdoor IRA. And what it is really, you know, you file, and this is the step here. You open a traditional IRA. You make after tax, you know, contribution into it. Then you file, you know, the form 8606. You know, so what what a Roth IRA does rather, you know, is it's not pre-tax money. It's like the money that you invest in a IRA, which is post-tax money. In the future, you're supposed to pay tax on it. But with a Roth IRA, because it's post-tax money you put into it, you don't owe taxes in future. So what a backdoor does is, since it's still, you know, post-tax money you put into it, if you file this in your Form 8606, you are allowed to convert that to a Roth. So it's post-tax money, and by filing Form 8606, you convert that into a Roth. Of course, subject to limits. You convert it into a Roth. That is, a Roth, remember what it means is that you don't owe tax in future, period. Even though by your income, you are beyond where you can do a regular or Roth IRA, which I will explain more the next time. They now allow you to still, through this backdoor method, still have a Roth IRA type investment. So that's the difference between backdoor and regular Roth. Backdoor is for those that are making a given amount of money. At least for the 2025 tax year, for a single person is 150,000. For a married couple, you can't put money into Roth if you make more than $236,000 together. But with this backdoor, there's no limit to, even if you make $10 million a year, you can still put money into a traditional IRA. And then when you file your taxes, through your taxing process, you file this Form 8606. And that traditional IRA, that's up to $8,000 of it, if you're above 50 years old, will be treated as a Roth IRA in the future. That is, if it grows from 8,000 to 800,000, you don't owe government tax on the growth. Whereas the amount that is left, that is in a regular traditional IRA, you're going to owe taxes in the future whenever you take it. That's the difference. Does that answer your question, Pastor?
Oh, sure, sir. Yes, sir. Yeah, it does answer the question. And then the last point I wanted to raise is just observation. For those who have maybe younger children, we always want to, we spend a lot of money going on vacations. Spring break or summer break, whatever, with the children, thinking that we are giving them the best. Is kind of guilty conscience is always what drives most parents to do those kind of expenses, to make those kind of expenses, which, I've realized, and I heard it before I even actually realized it, and I tested it on my children, and they can't remember that we went to Disney in Florida, but they could remember the one we just went probably about 6 years ago in California, but the one they went in 2009 in Florida, they can't remember it. So the point I'm saying is that, we take all these young children on expensive vacations because we want to give them the best, and it costs a lot of money. I think those money could be probably invested in 529 accounts, for them, and wait until they are much older to start to do those kind of expenses, because they won't remember. I think that the parents that they won't enjoy those vacations, but the reason for us making those expensive vacations is to give the children the best.
Thank you.
I'm not sure who has younger children, but almost every parent falls into that trap.
Thank you, Pastor. I don't want to sound like I don't want people to enjoy their life, but we need to be more sensible about these things. And the problem, Pastor, that I found is that people don't know what they can and cannot afford. That is where it starts. If you don't know that you can't afford that vacation, you're going to put it on a credit card, and then you get into debt. Then the negative accrual of negative of the compound interest now starts affecting you, prevent you from having money to invest, and then the negative accrual also accrues onto you. We need to do only what we can afford, and that starts with budgeting. That starts with what I've been teaching since last week. You know where you're going. You have a goal. Let's say the $1 million we talked about. You know the length of time. You turn that into your budgeting sheet. You walk it through. You see, look, I can't afford to do this line item. Then that means doesn't mean I can't go for a vacation, but what vacation can I afford? Many people don't know. That's why they do those things. And at the end of the day, the children we're going to talk about college savings in next class. So next class, we'll quickly review the top 3 that we talked about today, and then we'll go into all the other 10 or so. We'll talk about it in detail. This is so important, guys. This is where, so that money that you now set apart, where do you put it? One of it is in collect savings for your children that Pastor was talking about. 529, they call it, or Covidel. But we'll talk about that the next class. But please think about what Pastor just said. And can you afford those things? You know, I said it, I think it was in last class on one of my previous classes, that if you are not as big as a hippopotamus, don't breathe like one. You know, let's not allow people to drive us. Let's not allow our emotion to drive us. Let's be very, you know, detailed. Once you do these things that I've talked about, it will be clear to you between the husband and the wife what you can afford, what you cannot truly afford. And then you can still have a vacation, but maybe in a different location, maybe, you know, and still achieve all the other things you want to achieve. I pray that the Lord helps us. Thank you, Pastor, for sharing that. That's a, you know, a blessing. All right. I appreciate the contributions, the questions, the participation tonight. I like how, you know, they turn out very, very good. I think our next class, which is supposed to be, which is going to be next month, is scheduled for, let me see it on our chart. Is scheduled for the 2nd of May. So we'll continue this session on the 2nd of May. And then I'm going to have to add one more class because we couldn't finish everything today. And I don't want to rush it because this is important. And then we'll add one more class to this series before we finish. And so we'll have 4 rather than 3 classes. All right, thanks for the participation. I'm going to stop the recording now. And then I will, you know, it's going to be saved, you know, and then I can share that with us sometimes later. So again, thank you very much for the participation and the questions. Yeah. All right.
Thank you so much.